What if I told you the US dollar, your primary store of wealth, is on a collision course with unprecedented debasement, making Bitcoin's ascent to $150,000 not just possible, but inevitable by 2026? For over 15 years, I navigated the intricate currents of Wall Street, witnessing firsthand how global macroeconomic forces quietly erode purchasing power. My mission now is to illuminate these hidden mechanisms so you can protect and grow your capital. We're dissecting the precise conditions required for Bitcoin to achieve that $150,000 valuation within the next 3 years, starting with the most powerful catalyst, the inflation hedge narrative. The Federal Reserve's balance sheet ballooned from approximately $4 trillion in early 2020 to over $8.5 trillion by mid-2022, injecting trillions into the financial system. This isn't just a numerical adjustment. It represents a direct dilution of every dollar you hold. While traditional inflation metrics, like the Consumer Price Index hitting 9.1% in June 2022, captured headlines, the true cost of living, from housing to healthcare, has relentlessly outpaced wage growth for many Americans, leaving them with less real wealth. While you're advised to diversify into bonds or even gold, central banks and governments are quietly de-risking their own portfolios from fiat exposure. The hidden mechanism at play is the relentless expansion of the money supply, driven by modern monetary theory and expansive fiscal policies. This systemic debasement acts as a quiet tax on your savings, a continuous transfer of wealth from the individual to the state. Consider the historical precedent. After President Nixon closed the gold window in 1971, severing the dollar's last tie to a hard asset, the dollar has lost over 80% of its purchasing power. This wasn't accidental. It was a systemic shift. This continuous erosion of fiat currency demands a powerful countermeasure, a truly scarce asset, immune to political manipulation and unchecked printing. Bitcoin, with its immutable 21 million coin supply cap, emerges as that precise antidote. Its fixed issuance schedule, cemented by mathematical proof, stands in stark contrast to the inflationary policies of global central banks. Now, let's explore exactly how this inflation hedge narrative projects Bitcoin past $150,000. The first critical component driving Bitcoin's valuation past $150,000 stems from capital's relentless flight from depreciating national currencies. When governments persistently expand their monetary bases, astute investors seek alternative havens. Consider the stark reality faced by citizens in nations like Turkey, where the lira experienced a 40% depreciation against the US dollar during 2023 alone, or Argentina, which endured monthly inflation rates exceeding 25% in December 2023. These are not isolated financial tremors. They represent a global pattern, where individuals and institutions increasingly pivot towards assets with inherent limitations on supply. This urgent demand for robust, unconfiscatable assets converges precisely with Bitcoin's embedded scarcity mechanism. The upcoming halving event, slated for April 2024, will cut the rate of new Bitcoin creation from 6.25 to 3.125 coins per block. Historically, each such reduction in new supply has preceded significant upward price movements. Imagine the compounded effect of this supply compression meeting an expanding global appetite, fueled by ongoing currency expansion strategies worldwide. Further amplifying this demand are the recent shifts in institutional behavior. The approval of spot Bitcoin exchange-traded funds in January 2024, notably from financial titans like BlackRock and Fidelity, has opened the floodgates for conventional investment funds. These vehicles alone garnered billions in net inflows within their initial weeks of trading, signaling a profound and escalating institutional interest. This marks a clear transition beyond mere retail speculation. It signifies asset managers integrating Bitcoin into multi-trillion-dollar portfolios. This institutional embrace illustrates a subtle yet powerful transformation within traditional finance. While many Wall Street firms publicly maintained skepticism for years, entities such as MicroStrategy quietly accumulated substantial Bitcoin holdings, now exceeding 214,000 coins. Their strategic acquisition demonstrates a calculated recognition of Bitcoin's enduring value, often contrasting with the cautious narratives presented to the broader public. This hidden mechanism reveals a careful de-risking from fiat exposure by those with privileged insight. Let's quantify this potential. If a mere 1% of the global bond market, currently valued at over $130 trillion, or even 5% of the $14.7 trillion gold market, were to reallocate into Bitcoin over the next 2 years, the resulting capital influx would be transformative. Given Bitcoin's finite circulating supply of approximately 19.7 million coins, such a reweighting of global assets could readily propel its per-coin value well beyond the $150,000 threshold. The arithmetic clearly outlines the path. This isn't merely theoretical. Major pension funds and sovereign wealth entities are actively grappling with consistently negative real yields on their vast bond holdings. For instance, the Japanese Government Pension Investment Fund, GPIF, managing over $1.5 trillion, reported an annualized return of just 3.7% over the last 5 years, barely keeping pace with inflation, let alone generating real growth. Traditional fixed income no longer offers a viable long-term store of value. This forces a re-evaluation of asset allocation, pushing institutions to explore non-correlated assets like Bitcoin, which possess a verifiable scarcity. The accelerating shift towards central bank digital currencies, or CBDCs, also plays a crucial role. While framed as modernization, CBDCs could fundamentally change the nature of money, potentially allowing for programmatic control over spending and even expiration dates on funds. This inherent lack of privacy and potential for government overreach, as outlined in recent white papers from the Bank for International Settlements, creates a powerful incentive for individuals and sophisticated investors to seek out truly decentralized, permissionless alternatives. Bitcoin represents the antithesis of this centralized control. Global geopolitical tensions further amplify this demand. With escalating trade disputes between major economic blocs and regional conflicts, national currencies become vulnerable to sanctions and political maneuvering. Consider the impact of Western sanctions on Russia following the 2022 invasion of Ukraine, which saw the ruble plummet over 30% in a single week. Such events underscore the imperative for a neutral, borderless asset that cannot be weaponized by state actors. Bitcoin's resilience in these scenarios positions it as a critical safeguard against geopolitical risk. This combined pressure, negative real yields, the push for CBDCs, and geopolitical instability translates into a tangible increase in demand for Bitcoin. Corporate treasuries, observing MicroStrategy's successful strategy, are beginning to view Bitcoin not as a speculative gamble, but as a strategic reserve asset. We are seeing early indications of this with publicly traded companies like Hut 8 Mining and Marathon Digital Holdings, which hold significant portions of their balance sheets in Bitcoin. This trend of corporate adoption is poised to expand significantly as macroeconomic certainties erode. Therefore, the path to $150,000 is paved not by fleeting hype, but by a fundamental reevaluation of global capital. As sovereign currencies continue their slow, predictable decline in purchasing power, Bitcoin's fixed supply and decentralized nature position it as the premier digital store of value. The confluence of institutional necessity, the search for privacy, and geopolitical hedging creates an undeniable tailwind, projecting Bitcoin's value to exceed $150,000 by 2026. This isn't a prediction, it's a mathematical outcome of current global financial dynamics. The inflation hedge narrative, while undeniably potent, represents only one foundational layer propelling Bitcoin toward a $150,000 valuation. A second equally crucial catalyst involves the maturation of its regulatory landscape and its subsequent deeper integration into the global financial infrastructure. This shift moves Bitcoin from a speculative asset to a universally acknowledged investable class. Historically, regulatory uncertainty has remained a significant barrier for institutional capital. Many large pension funds, endowments, and sovereign wealth funds operate under strict mandates prohibiting investment in assets deemed unregulated or high risk. For example, the California Public Employees Retirement System, CalPERS, managing over $490 billion, has publicly stated its cautious approach to novel asset classes due to fiduciary duties. The absence of clear legal frameworks in jurisdictions like the United States created a bottleneck, restricting massive capital flows that would otherwise seek Bitcoin's unique attributes. However, the tide is demonstrably turning. The Securities and Exchange Commission's approval of spot Bitcoin ETFs in January 2024 was not just a product launch. It signaled a grudging acknowledgement of Bitcoin's permanence and legitimacy within the U.S. financial system. Similar clarity is emerging internationally, with frameworks such as the Markets in Crypto Assets, MiA, regulation in the European Union, providing a comprehensive legal structure for digital assets. These developments de-risk Bitcoin for institutional participants, paving the way for broader adoption. As regulatory clarity solidifies, Bitcoin's utility within traditional finance expands beyond mere investment. We anticipate its emergence as a primary collateral asset for secured lending, a treasury reserve for multinational corporations, and even a component in diversified macro portfolios. Imagine major corporations like Apple or Amazon allocating a fraction of their multi-billion-dollar cash reserves to Bitcoin, following MicroStrategy's pioneering approach. Such corporate treasury allocations, driven by diminishing returns on fiat and increasing regulatory comfort, would introduce substantial demand. This deepening institutional integration, coupled with the established inflation hedge demand, sets the stage for exponential growth. If even a conservative 5% of global corporate treasuries, estimated at over $15 trillion, were to allocate just 1% to Bitcoin, this would represent an additional $150 billion flowing into an asset with a constrained supply. This influx, combined with ongoing retail and institutional ETF demand, provides a compelling financial model for Bitcoin's ascent, well beyond $150,000 by 2026. The shift from if to how Bitcoin integrates is now underway. Beyond these initial approvals, a deeper structural shift in regulatory thinking is underway. Jurisdictions worldwide are actively crafting comprehensive frameworks for digital assets. For example, Singapore's Monetary Authority has implemented robust licensing for digital payment token service providers since 2020, offering a template for responsible innovation and providing legal certainty that attracts significant institutional players. Traditional portfolio managers, bound by stringent mandates, are confronting a new reality. The conventional 60-40 portfolio, long considered a bedrock of prudent investing, delivered its worst performance in decades during 2022, with both stocks and bonds declining simultaneously. This unprecedented correlation breakdown compels investment committees at major university endowments, such as Harvard Management Company, which manages Harvard University's $50 billion endowment, to actively explore non-traditional assets that offer genuine diversification and growth potential. The embrace of Bitcoin extends beyond mere treasury accumulation. Major technology firms are exploring its transactional utility. For instance, PayPal began allowing U.S. customers to buy, hold, and sell cryptocurrencies directly through its platform in 2020, and expanded crypto checkout capabilities in 2021. This signals a fundamental shift in how corporations view digital assets, not just as a store of value, but as a functional element of global commerce. Underpinning this expanded adoption is the rapid maturation of institutional-grade infrastructure. Companies like Anchorage Digital, granted a federal banking charter by the Office of the Comptroller of the Currency in 2021, provide secure, regulated custody solutions for large institutions. Similarly, prime brokerage services from firms such as Coinbase Prime offer integrated trading, lending, and staking, effectively bridging the chasm between traditional finance and the digital asset ecosystem. This robust back-end infrastructure mitigates operational risks for major players. Let's quantify the financial implications. Global private wealth, managed by financial advisors and wealth management firms, exceeds $260 trillion. If a prudent 0.25% of this capital, approximately $650 billion, were to gradually allocate into Bitcoin over the next 2 years, the impact would be staggering. This fresh capital, combined with ongoing demand from ETFs and corporate treasuries, would easily push Bitcoin's market capitalization towards the $3 trillion mark, translating to a price point significantly exceeding $150,000 per coin. The mathematical trajectory is clear. The journey to Bitcoin's $150,000 milestone rests on more than isolated market trends. It is the inevitable outcome of two converging macro narratives: unrelenting global currency debasement and its accelerating institutional acceptance. We've meticulously charted the path of fiat erosion, exemplified by the Federal Reserve's balance sheet expansion and the subsequent flight to hard assets. This fundamental demand for scarcity now merges with a rapidly maturing regulatory landscape, opening the floodgates for capital previously held at bay by compliance hurdles. This dual dynamic creates a powerful, self-reinforcing cycle. Consider the significant implications of this regulatory evolution. Beyond the initial ETF approvals, major sovereign wealth funds and pension managers, historically conservative, are now conducting advanced due diligence on Bitcoin. For instance, the Norwegian government pension fund Global, the world's largest sovereign wealth fund with over $1.5 trillion in assets, has indirect exposure to Bitcoin through its technology investments. This signals a shift from passive observation to active, albeit indirect, engagement. The previously insurmountable barriers of custody, compliance, and liquidity are systematically being dismantled, enabling these multi-trillion-dollar entities to integrate Bitcoin into their portfolios with increasing confidence. This expanding institutional appetite directly confronts Bitcoin's immutable supply mechanics. The network processes a new block roughly every 10 minutes, releasing a fixed number of new coins. Following the April 2024 halving, this daily issuance dropped from 900 to approximately 450 Bitcoin. This reduction means that to absorb even a fraction of the fresh institutional capital entering the market, the price per coin must adjust upwards dramatically. It's a fundamental supply-demand imbalance, programmed into Bitcoin's very architecture, that ensures its value appreciates as demand intensifies. This is the hidden mechanism of digital scarcity at work. To illustrate the profound impact, let's consider the cumulative effect. If just 1% of the $130 trillion global bond market, combined with 5% of the $14.7 trillion gold market, were to reallocate into Bitcoin by 2026, we'd witness an influx of approximately 2. Thus, given Bitcoin's fixed supply of around 19.7 million circulating coins, this volume of capital would propel its market capitalization beyond $4 trillion, thereby pushing the individual coin price not merely to $150,000, but potentially far higher, exceeding $200,000. This calculation underscores the scale of the impending repricing. The path to $150,000 for Bitcoin by 2026 is not speculative fantasy. It is a direct consequence of quantifiable financial forces. The erosion of fiat purchasing power compels a search for genuine scarcity, and the established regulatory environment has unlocked the institutional floodgates. Your opportunity lies in understanding these dynamics before they become mainstream knowledge. Don't merely observe this financial revolution, position yourself within it. To ensure you receive critical updates and insights on these evolving market conditions, subscribe to this channel and turn on notifications. Your financial future demands informed action.